Hello, my name is Nicole, and this video is about the synthetic long put strategy. Professional traders understand that mastering derivatives isn't just about knowing individual strategies, it's about understanding how different instruments can be combined to create identical risk exposures. Today we're exploring the synthetic long put, a strategy that pays to understand. By the end of this video, you'll understand not just what a synthetic long put is and how it works, but more importantly, you'll grasp the deeper principles of options equivalency that separate sophisticated traders from the rest. We'll dissect its risk-reward profile, analyze the Greeks, examine the strategic advantages and limitations, and explore when this knowledge gives you a real edge in the markets. So what is a synthetic long put? A synthetic long put is a strategy that replicates the payoff of owning a put option by combining two different positions. First, you sell stock short, which entails borrowing and selling shares you don't own. And next, you buy a call option for protection. Think of it like this: instead of buying a put option directly, you're creating the same economic outcome using other instruments. Let's hop into the Tasty Trade platform here, and we're going to use NVIDIA as an example to illustrate what we're talking about. You can see here NVIDIA has been on a tear lately, and for this example, we're just going to assume that I think NVIDIA is going to crash and burn, although in the real world, I would never assume such a thing. Okay, to construct the synthetic long put position, I'm going to short 100 shares at the current market price, and then I'm going to go out and buy a protective call, and I'm going to choose the September 19th, 2025 expiry to do this. And I'm going to select the 175 strike call option to purchase. And this completes the position. And I have a negative delta of 48, a negative theta of 9. I can realize a max profit of just over $16,000. My max loss is around $1,300. And to put this trade on, it would reduce my buying power in my margin account by $9,853. And when we look at the profit and loss at expiration, we're going to see that the max loss is capped at just over $1,300 if NVIDIA were to continue to move up. And our gains grow as NVIDIA sells off. And of course, those gains are going to be capped once NVIDIA were to hit zero. Low probability, but that is the max gain. Now, I want to replicate this position with a long put, and so I need to match up the delta. And lo and behold, if I buy a put at the same strike as where we bought a call, the deltas match pretty well. So to replicate this trade on the long put side, we're going to have a negative 48 delta, negative theta of 8, max profit around $16,000, max loss of almost $1,200. And the buying power effect on this is going to be much less at around $1,195. And when we look at the P&L at expiration, the profiles look nearly identical. So they have the same characteristics other than the buying power effect. Now, let's take a look at another example. Let's assume I am short NVIDIA 100 shares, and I'm a little more confident in my position. So I want to buy some protection, but I want to go further out of the money. So if I buy 195 strike call against the 100 shares, we're going to see that that gives me a negative 75 delta, a max profit of just over $16,000, a max loss of $2,600, and buying power reduction of $9,113. And when we take a look at the P&L at expiration, you can see that the loss is a little higher than the previous example. The break even is a little better, and the gains grow as NVIDIA price goes down. So once again, to replicate this with the long put, we're going to try to replicate the delta. And once again, if we buy a put to replicate the delta, it's going to be at the same strike price as the long call strike price in the synthetic. So I'm just demonstrating here how similar the risk profile is. And this position would reduce my buying power by $2,465. And once again, the P&L at expiration is nearly identical to the synthetic long put. The only difference is the buying power effect. So the synthetic long put is definitely not as capital efficient as just buying a long put. Now let's talk about break even and profit and loss. You break even when the stock price has declined by exactly the amount of the premium you paid for the call option. Break even, therefore, is calculated by taking the short sale price minus premium paid. Your max profit is limited but substantial. The best case scenario is if the stock becomes worthless. Therefore, your max profit equals the short sale price minus the premium paid. And finally, your max loss is limited and defined. The worst case is if the stock is trading above the call strike price at expiration. Therefore, your max loss calculation is the strike price minus the short sale price plus the premium paid. Now let's cover the advantages of the synthetic long put strategy. The first advantage is flexibility. You can adjust the strategy easily by rolling the call option or adjusting the short stock position. Next is liquidity benefits. In markets where put options have poor liquidity, this strategy can provide better execution. And next would be extreme negative skew. In markets with extreme negative skew, this makes put options much more expensive relative to call options, potentially giving this strategy an edge over simply just buying long puts. Now let's cover the disadvantages of the synthetic long put strategy. And there are a few big ones. First is the short sale risks. Short selling comes with unique risks. Borrowing costs can eat into profits. You'll pay a daily fee to borrow shares, which can range from minimal for easy to borrow stocks to substantial for hard to borrow shares. These costs are typically expressed as an annual percentage, but are charged daily, and they can fluctuate based on supply and demand for the shares. Next is dividend risk. If a stock pays dividends, you are responsible for paying them to the share lender when you're holding short stock. The next one is potential forced buy-ins. If shares become hard to borrow, this means your broker can force you to close your short position by buying back the shares at the current market price, regardless of whether it's profitable for you or not. This typically happens when the original share lender recalls their shares or when there's an insufficient inventory available to borrow. And finally, you can have unlimited risk if the call is allowed to expire without opening another call position or exiting the short shares. And another big disadvantage is the capital requirements. This requires a margin account and significant capital to maintain the short stock position. These capital requirements are much larger when compared to simply buying a put option. And finally, complexity. You have to manage two positions instead of one, which increases complexity and potential for errors. So when is the best time to use the synthetic long put strategy? Well, here are the ideal scenarios. First, overpriced put options, when extreme negative skew makes puts expensive relative to calls and you are bearish on the stock. Next is poor put liquidity. In stocks with wide bid-ask spreads on puts, the synthetic approach may offer better pricing. And finally, this is mostly used as an adjustment strategy. It's often used on existing short stock positions rather than an initial strategy. The market conditions for which this would be appropriate include markets with good short availability, stocks with liquid call options, and when you expect sharp, quick price declines. So here are my final thoughts on this strategy. The synthetic long put is a sophisticated strategy that replicates put option exposure through short selling and call buying. The biggest drawback is its high capital requirements, borrowing costs, dividend obligations, and increased complexity. Even though you may not find an immediate use case for synthetic long puts, understanding this strategy and synthetic concepts will make you a smarter trader, and smarter traders are more profitable traders. Remember, this strategy involves unlimited risk if the call option is allowed to expire without exiting short shares. It requires significant capital and is best suited for experienced traders. Always paper trade complex strategies before risking real money. If you found this video helpful, please like and subscribe for more options education content. Drop a comment below with your questions about synthetic strategies. I read every one. In the next video in our 6-part series on synthetics, we'll explore synthetic short stock, so you won't want to miss it. As always, thanks for listening and be awesome.